Hello guys, so today is our first session where I'll talk about correlation according to the CTP methodology, what equivalent lines are and how to identify correlation opportunities, and I'll show a few real market examples. In the CTP methodology, correlation refers to the price action of two or more correlated assets relative to their key levels. And there are three types of correlation. ES and NQ are highly correlated with positive correlation. USD and GC, the gold futures, are negatively correlated, and ES and GC have no correlation relationship at all, not negative and not positive. For positive correlation, this means that when an instrument bounces off a key support level, we expect its correlated asset to do the same, to bounce off its key support level as well. For the negative correlation, this means that when an instrument bounces off a key support level, like the GC here, we expect its inverse correlated asset to do exactly the opposite, to bounce off its resistance level. So when a long signal is generated on GC, a short signal is generated on USD. Short opportunities for USD can be good long opportunities for GC and vice versa. So according to the CTP methodology, for two highly correlated instruments like ES and NQ, we expect similar behavior. Similar behavior when bouncing off their key levels, when breaking through them, or when they generate intraday support and resistance key levels. I'll explain the intraday in detail in the next lesson. Guys, in contrast to traditional correlation methods, in the CTP methodology, we look for synchronization between two correlated instruments when both reach their key levels together. So the timing matters. Key levels are the key, and synchronization is another key in the CTP methodology. By the way, that's why CTP is not relevant on charts where the time is eliminated, like Renko charts. Note that it's crucial to use fixed key levels, meaning levels that do not repaint or are known after the fact, and zero settings to fine-tune. In other words, the EG trigger points. Guys, the EG trigger points satisfy the CTP requirements. Why? Because the levels are fixed, they do not repaint, they are delivered at least 10 hours before the market opens, and, zero settings to fine-tune. Again, in the CTP methodology, the timing matters. For instance, ES and NQ, they are highly correlated. When they reach the resistance level, there's a high chance of bouncing back off them. In addition, in the CTP methodology, we do not consider any numerical values that represent the correlation between the instruments, like in the traditional methods or indicators. Why? Because these values lag, and they do not provide any actionable insights for me. I'm looking for concrete entries, right? They are useless. However, by observing the market's behavior when they reach their key levels, there's a higher chance of rejection, especially when there's a large distance between the levels and the momentum is weakening. A key concept in the CTP methodology is line equivalence. At this point, I identify an A+ setup. Why? Because both NQ and ES are reaching their trigger point, because both already made a big move to the upside, indicating that their momentum is weakening. Both are reaching their resistance trigger point, so I enter the short trade more confidently. Now, speaking about spotting equivalent lines for identifying CTP opportunities, these two lines I shorted here are equivalent. So to identify an A+ setup in the CTP methodology, I need to spot equivalent lines, meaning key levels where the correlated assets are getting close to expecting similar behavior. I identify equivalent lines ahead of time, guys, so I can get ready to take my trades off of them. Guys, the CTP does not lag. In this example, these two lines here are equivalent in the CTP methodology, providing you with beautiful long opportunities. And here, these lines are equivalent, providing you with short opportunities. So how to identify correlation opportunities? First, you need to take two correlated assets and attach their key levels to your charts. Because remember, we only refer to the behavior of them relative to their key levels, our trigger points. Then you need to monitor them and verify that they are reaching their levels at the same time. When this happens, the trades can be taken more confidently. Now, there's a tricky part here because look, ES is closer to its resistance level than NQ. However, guys, because of NQ's volatility, we expect it to reach its trigger point together with ES. Remember, guys, key levels expect to drive the market reaction, and they are also areas of magnets. The market wants to reach them due to the liquidity there. So this setup indicates to me that they will reach their levels together. Guys, this is an A+ CTP setup for me to go short on both. And by the way, if NQ was here, I would expect it to break its resistance a little until ES is reaching its resistance. Why? Because ES wants to reach its resistance level. It is a magnet for it, and we see it all the time. So this can be useful in detecting false breakouts. CTP can help you identify false breakouts and avoid market traps. So when this is the case, when NQ is closer to its resistance level, I expect it to break through a little until ES is reaching its resistance level and then getting back down. In such cases, you can use one micro without tight stop loss and add another one after ES is reaching its trigger point. Or you can wait patiently for ES to reach its resistance and take the short trade on NQ after NQ is getting back down from its false breakup. Now, let's say there was another line here on NQ. In this case, guys, I'm waiting for NQ to reach its second line, monitoring them together. I'm waiting for NQ to reach its second line to short it. So CTP is about monitoring two correlated assets, and finding CTP opportunities is about monitor them when they are reaching their levels together. Now, what's the meaning by reaching together? Let's take a look at the example here. This is a trade I took in the live trading room 2 days ago during the London session. you can see ES at the top here and NQ at the bottom here. So first, you can see a reaction of ES to its support level here. At this point, NQ is above its level, indicating that they align. They agree. At this point, there's no disagreement between the instruments. Both are above a support level. So speaking about spotting equivalent lines, these lines are equivalent according to the CTP methodology. At this point, they are equivalent support lines. But then, as you can see, ES broke. ES broke, its support level turned into resistance. Resistance then was validated. We can see the retest here, which is an expected behavior when a level is broken. So at this point, ES and NQ disagree. Why? Because an equivalent line is a resistance for ES, but still support for NQ. So at this point, ES and NQ disagree. Remember this term, guys, disagreement. Disagreement for two correlated assets is identified when their equivalent line is support for the first asset and resistance for the second one. For ES resistance, for NQ support. So this is where the correlated assets disagree. Guys, when they disagree, one of them will break its level. Either NQ will break its support, like we see here, or ES will break its resistance. So in this case, NQ broke its support. So resistance is validated by ES. We can see the retest here after the support broke. Retest. This is indicating to me that this is a resistance level. But at this point, NQ is above the level. It's a support level for NQ. Then a beautiful breakdown candle is observed on NQ as expected. In this case, NQ is following ES. ES is the leader here, and NQ is the follower. NQ broke its support. Support turned into resistance. Beautiful retest. Both agree, and this is an A+ setup for me to go short on NQ, guys. To summarize, in the CTP methodology, we spot equivalent support lines. Here, we spot equivalent support lines. ES broke its support. NQ was above its support. They disagreed. Then NQ followed and broke. Support turned into resistance. NQ retested its resistance. And a beautiful CTP short signal was established. And this is how it looks using the correlation indicator. Look, it generated the short signal for me before the retest, okay? Giving me enough time to get ready for the short trade here. So this was an A+ setup for me, and this was a CTP trade I took during the live trading room 2 days ago. Again, ES broke its support, retested, confirming the support line turned into resistance. And a few minutes later, a breakdown candle was observed on NQ and a retest. There's a high distance between the trigger points, indicating that there's enough room for NQ to go to the downside. Guys, this was an A+ setup for me to short NQ. So CTP can help you to identify A-plus setups, avoid market reps, and the third thing, to identify profit targets. If we get back to this example, I used ES trigger point as a profit target for the short position I took on NQ. And this leads me to the next important topic, using correlated assets trigger points to spot profit targets. You know that the trigger points can also be useful to spot potential profit targets. However, sometimes there can be a large distance between them, and this can make you feel unconfident to hold the position that long. In this example, I used ES support level as my profit target for NQ, and it worked out nicely, as you can see. So when you are in a short position, a correlated asset support level can be considered as a profit target. Now let's take a look at a few examples.